What a week. It is only Wednesday and we already had huge earnings from Lemonade and Fubo TV. Fubo TV stock going up 28% after hours and Lemonade went down 7.5% after hours. Hello everyone, welcome back to the channel. Today we will analyze Lemonade earnings, their stocks, explain what happened and more. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Also, I posted a video this morning analyzing Fubo earnings in case you are also interested in watching that after this video. Now, you guys know I love Lemonade, their business, their ideas, and everything. That is why I started investing in this company when they decided to go public, because I think they are able to disrupt one of the oldest, if not the oldest industry, the insurance industry. After the earnings, I will update you guys with my position. The stock has been dropping massively since January, almost 60% drop, just like many growth stocks, but let's see how they did. Let's start. It was funny how they started their shareholders letter Q1 2021 with a car emoji right at the very first page, because I would imagine that they know car insurance will be a big thing for them, and we are going to see why later on the video. To start, their force premium grew 89%, which was very nice. Premium per customer 25%, and total customers grew 50% year over year. Their gross loss ratio increased by a lot to 121% because of the Texas freeze, which we will talk about that later in the video. And their gross earned premium grew 84% year over year to $56 million. I do want you to remember that growth of 86% and $56 million in gross earned premium. Now, they said that the car insurance industry in the United States is estimated to be a $300 million market, with more than 9 out of 10 American households owning at least one car. And here is the huge potential that they have. Car insurance market is 70 times renters, 80 times pet health, and 3 times homeowners, which is a huge long-term potential because, as they said in their earnings call, apparently their customers with homeowners insurance already spent about $1 billion in auto insurance, which could be potential revenue for them from their customers, plus the new ones that will come with time. They are already seeing overwhelming demand for Lemonade car insurance. This is something I like. Lemonade car will use technology to handle emergencies and pay claims fast. Will offer great prices to save drivers, and will be attractive to drivers of EVs and environmental friendly cars. Also remember that they target millennials and younger people to be able to grow while we grow with them, so their newborn products are graduating from infancy ever faster. This acceleration is largely enabled by channel diversification, improving brand awareness, and a machine learning driven growth engine that constantly iterates to improve each step of our onboarding funnel, which is what I like the most about the company. The more data they collect, it will help their system to improve faster, provide a better service throughout AI, which will help them grow faster as a company. And that is what have helped them grow and expand even faster, since in July 2020, Lemonade customers could buy renters and homeowners insurance. That was all. Now, there are a multitude of entry points to Lemonade: renters, homeowners, pet health, and term life, with car next on the roadmap. All that in less than 1 year, which has also helped increase their annual dollar retention, which is a percentage of their in-force premium retained over a 12-month period, inclusive of changes in policy value and more. That annual retention rate is now 81%, which is nice and has been increasing year over year from 67% in 2019 all the way up to 81% in 2020. Now, what happened with their loss ratio was because of the Texas freeze. I would imagine all of you remember what happened with Texas at the beginning of the year.
Not outside, in here. Don't go outside, it's too cold.
1,000 waking up without power in Texas this morning. All over that great state.
And there's more dangerous weather.
It was awful, and obviously their homes suffered a lot, as you could see in those videos. That is why Lemonade received about a year's worth of claims in its first few days, which brought some challenges to the table. Operational stress tests with so many claims at once, but apparently their team and technology were able to fully resolve claims within a week. Then financial stress test, because claims due to CAT added 50% points to our gross loss in the quarter, but our EBITDA guidance for the year remains substantially in line with analysts because they have extensive insurance programs in place for when this kind of things happens. Now, let's check their financials because there is something I want to clear out that I thought I didn't need to do it, but I read a lot of tweets yesterday about this. As you can see, they reported a revenue of $23.5 million, which if we compare it with last year's, it is awful because it decreased. So how can someone explain why Lemonade customers are growing and their in-force premium is growing and everything is growing except for the most important thing, their revenue? Easy. They had a proportional reinsurance agreement that started in Q3 2020, meaning that the proportion of premium ceded is now 75%, which helps them with capital efficiency and all that. What this means is that by every dollar that they receive as a gross earned premium, they cede 75% to reinsurers. Remember I told you guys to memorize the 86% growth and $56 million that they had in gross earned premium. Well, that was actually the revenue from premiums. Let's call it like that. But because they cede 75% of that, they actually had a net earned premium of $13.8 million. So that is why we see a decrease in revenue, because now they cede 75% of it. And that is why they explain it is difficult to do a year-over-year comparison right now, because they started with the reinsurance program in Q3 last year. Just making sure, because I read a lot of comments saying that they didn't even had a growth in revenue, and that is what happened. On their balance sheet, they have cash and cash equivalents of $1.17 billion, total asset of $1.47 billion, and total liabilities of $333 million, which is actually a nice balance sheet since they have a current ratio of 3.39, which is excellent, and a price to sales ratio of 41, almost 42, which I know it is high in comparison to the industry, but the truth is that we can't compare it only with the insurance industry, because Lemonade is a high growth tech stock as well. They are trying to disrupt the existing insurance industry with technology, and the expected growth is way higher than with any other old insurance company. Now, they actually raised their guidance. They are expecting between $283 to $288 million in in-force premium for the quarter and about $380 million for the whole year. Gross earned premium of $63.5 to $60 million for Q2, which I think is excellent, and $283 million for the whole year. Total revenue of $27 million for the quarter, $120 for the whole year. On their earnings call, they were asked if they will get affected by the new iOS 14, if they will have problems collecting data, and the answer was no, simply because they don't advertise, they don't sell the data, but they only use the data to improve their business and current products to attract more people. Now, right now, I'm only up 12.05% of my position, and I said only as a bad thing, but I was up almost 200% at one point when the stock got really overvalued. But the question is, what do I think about their earnings and what is my plan with the stock? I do have to say that I like their earnings. The stock dropped even more because they reported a wider than expected net loss due to the Texas storm, which I know it was terrible, but they were able to clear all that and still be able to see growth. I want to see their second quarter numbers, and I'm planning on adding to my position if it drops below $60, which is almost getting there. It is right now 10:28 a.m. and it's still at $63 per share. As said many times before, this is a very volatile stock, and I don't expect that volatility to stop in the coming months or even year. But what do you think about their earnings? Any concerns, or are you happy with the company? Let me know in the comment section below. If you enjoyed the video, please subscribe and smash that like button since it really helps the channel out. Also, I have a completely free Discord group chat, which the link for that is down in the description below. Thank you and see you next time.